All right, today we are cracking open a really fascinating case in the food industry. We're putting two giants under the microscope. You've got the global titan, Kraft Heinz, and then you've got the fast-moving challenger, Utz Brands. And you're going to see how a headline that looks absolutely catastrophic might just be hiding a completely different story.
So let's start at the scene of the crime, right? There was this one headline-grabbing number that sent shockwaves through the market and had everybody asking this exact question. What on earth could possibly be so bad?
That's it right there. A loss of $5.8 billion. Now, look, this isn't some fly-by-night startup. This is Kraft Heinz. Their products are basically part of our cultural DNA. Seeing a number like this from a household name, it's kind of like finding out a skyscraper has a giant crack in its foundation. You just have to wonder what's going on.
So, did the giant really fall, or is there something else going on here? Well, to solve this mystery, we need to look past that big, scary number, dust for some fingerprints, and examine the real evidence. And here is the culprit. The crucial point here, you got to understand, is that no cash actually vanished. This loss, it comes from what accountants call an impairment charge. Basically, Kraft Heinz had to admit, on paper, that the future earning power of some of its famous brands just wasn't as high as they once thought. So it's not a mortal wound. Think of it more like a giant, very expensive paper cut.
Now, to really get what's happening, we can't just look at one company by itself. So let's bring in our challenger, Utz Brands, and use this really powerful detectives tool called the DuPont analysis. It basically breaks down how a company actually makes a return, letting us see all the machinery behind the curtain.
Okay, and here is the initial rap sheet. Now, if you just look at that final number, return on equity, or ROE, well, it looks like an open and shut case, right? A total disaster for Kraft Heinz, and this tiny, almost invisible win for Utz. But, as any good detective knows, the real story, it's always hidden in the details.
So first up, net margin. This is basically how much of every single dollar in sales you actually get to keep. Now, Kraft Heinz's pocket looks like it's been ripped wide open, but we already know why, right? It's that $9.3 billion paper loss. If you just ignore that for a second, their actual gross margin, the money they make on their products before other expenses, is a really healthy 33.3%.
Next is asset turnover. Think of this as how efficiently a company uses its stuff, its factories, its trucks, its inventory to make sales. And here, the contrast is just stark. Utz is like a small, speedy little factory, cranking out sales much faster for its size. Kraft Heinz, on the other hand, is this much bigger beast, and it's just slower with its massive base of assets.
And finally, the equity multiplier. This is our risk gauge. It tells us how much a company is leaning on debt. So imagine you're standing on a stack of books labeled debt to reach a higher shelf. Well, Utz is standing on a stack nearly twice as high as Kraft Heinz. They're using a lot of borrowed money to fuel their growth. It's a classic high-risk, high-reward strategy. Accounting profits can be, well, let's just say they can be creative. They can be pushed around by things like paper losses. But cash doesn't lie. So let's follow the money and see who's really generating the cold, hard cash and what they're actually doing with it. And boom, this one slide tells the real story. Despite that ugly net loss, Kraft Heinz is an absolute cash-generating machine. It's churning out over $4.4 billion from its operations. And after investing back into the business, it's left with a mountain of free cash. Utz? Well, it's just barely cash flow positive.
This difference in cash flow really tells us everything about who these companies are. Kraft Heinz is the classic cash cow. It makes so much cash it can easily fund itself and still hand back nearly $2 billion to its owners in dividends. Utz, however, is the growth gambler. It takes almost every single dollar it earns and bets it right back on the business, hoping for a huge payoff down the road.
Okay, so now that we've seen the financial blueprints, let's look at the strategic playbooks. How are these two companies actually fighting it out in the grocery aisle? That cash flow story gives us a pretty big clue.
What we're seeing are two totally different battlefield strategies. Kraft Heinz is playing defense. They're protecting their profitable fortress by raising prices, even if it means some people stop buying. And their management has been very open about this trade-off. Utz, on the other hand, is on an all-out attack, storming new territories by keeping prices low to grab as much market share as they possibly can.
And right here, you can see the results of that defensive strategy. They successfully pushed through price hikes of 0.7%, but the cost was steep. The actual amount of stuff they sold dropped by a pretty painful 4.1%. So they won the battle on price, but they took a heavy hit on the battlefield of volume. So, After our full investigation, after we've examined the books, followed the money, and analyzed the strategy, what is the final verdict? Let's put it all together on our official scorecard.
This scorecard really lays it all out, doesn't it? Kraft Heinz's profitability looks deceptively low on paper, but its core is strong. It's a cash-generating machine with a defensive strategy. Utz has razor-thin profits because it's an aggressive growth gambler using debt to attack the market. These are fundamentally different animals, and they're playing for completely different outcomes.
So, the most important point here is this: that initial headline was a total red herring. Kraft Heinz isn't collapsing. It's a mature giant on a diet, slimming down and focusing on cash. And Utz isn't just barely profitable. It's a high-growth company investing every spare dollar in its own future. They're playing two completely different games. One is a stable, income-producing bond. The other is a high-risk, high-reward lottery ticket. The real question is, which game do you want to play?
If this kind of deep dive analysis can help you make better strategic decisions, our contact information is right there on the screen. Thanks for joining this explainer.